Hello friends, welcome to Learning Sessions, and today in this video we are going to discuss about the very important chapter that is related to the working capital finance over there. So let's start the session over here without wasting any time. So please do confirm the video quality at the earliest, and further, if you have not subscribed to the channel yet, do subscribe it at the earliest. And we have got the full course videos for JIB, CIB, bank promotions and certification courses, in which you will be getting the full course videos, case study videos, chapter wise previous questions, mock test, mega mock test, and the complimentary access to the ePDF notes. And that would be just more than sufficient for clearing the exam in the very first attempt. So what are you waiting for? Just do enroll right now. The link is in the description below. And if you are using application, you can download our Android application, which is available in the name of IIBF Learning Center. And if you are iOS user, do download My Institute application and use the organization code listed over here, that is GEGKD. And if you have any query related to the same, you can get back to us at the number 83609442207, also mentioned on the top right corner of the screen over there. So do the thing right now. Just do visit the link, download the application, enroll into the courses, and do not forget to use the coupon code NEW2023 so as to get flat 82% off on the courses over there. So let's begin with the session over here. It's related to the working capital finance. So let's take the case that we are having a firm XYZ over here, and further, this firm actually requires the finance for day-to-day purposes over there. Now the amount of the finance that is required for day-to-day activity, that is said to be the working capital. What we called it? We said it to be the working capital. Now if you want to understand it in detail, we must be understanding the components of the balance sheet over there. So in the balance sheet, we are having the liability side on one side, on the other side we are having the assets, and further these liabilities are what? These are the sources through which the finance is available to the corporate over here, and further the assets are said to be the uses over here, and further this amount which is sourced over here is going to be used in this sources over here. And if we talk about the classification of the assets and liabilities, we are having the capital and reserves, we are having the long-term liabilities, we are having the short-term liabilities, which are said to be the current liabilities over there. And on the asset side, we are having the fixed assets, we are having the non-current assets, we are having the current assets, and the intangible assets over here. Now, if we talk about the definition part, I have already told you the amount that is required by the company or the corporate for day-to-day activities, that is said to be the working capital. Now, if we look at the mathematical equation related to the same, it is actually the current assets minus current liabilities. The amount by which the current assets is exceeding the current liabilities, it is actually the working capital available with the company itself for day-to-day activities. Because let's think it that way, that if we are having rupees 10 in hand and further rupees 8 is actually related to that particular amount that we are to pay, so only rupee 2 we are having in hand, which we can actually spend on our working itself or day-to-day operations itself. Okay. And also the other important point that you need to understand, like I told you that we are having the capital and the reserves over here, which are actually going to be there for a longer period. So these are not the short-term liabilities over there, these are long-term sources of the funds over there. Okay, and these long-term sources of funds are actually utilized to finance the fixed assets, non-current assets, and somewhat part of the intangible assets also. Okay, now the amount actually by which this long-term liabilities, the LTL and the capital and the reserve part over here is exceeding the fixed assets or the long-term sources uses over there, that is actually the amount which can be utilized by the corporate so as to fix the working capital over there. Okay, so that's the second definition, that is, we can say that is a long-term liabilities minus the long-term uses. So that is also the definition part related to the same. Now let's understand the other part. Over here it is written the term gross working capital. Now what is gross working capital? So it is the total amount of the current assets which is available with the company itself. So let's say that we were having the current assets equal to 200 lakhs over here. So over here 200 is what? 200 is a gross working capital which is available. Now see, gross working capital is 200 crore over here, or 200 lakhs over here, whatsoever the amount it is. Okay, and let's say the current liabilities were 175 lakhs over here, or 175 crore over here. Let's just make it 175 crore and 200 crores over here. Okay, now the net amount which will be available with the corporate for the working capital purposes, that will be 200 crores minus 175 crore, that is 25 crore over here. So this is actually what? This is the net working capital, and further the gross working capital is equal to what? It is equal to 200 crores over here. I hope that you must have understood this particular concept related to that what is working capital, and further what is gross working capital, and what is is net working capital over here. Now let's move further. It's related to that current assets is actually related to different current type assets over there. Now current assets are those assets which actually do change their form from one form to another during a tenure of 12 months. Like we are having the cash, bank balances, stocks, the bill receivables, account receivables, book debts, and further the stock, inventory, etc. These all come under what? These all come under the current assets, and the stock and inventory is consisting of the raw material, work in progress, and the finished goods. Okay, so if we just look at the working capital cycle over here, what happens actually? Let's say we were having the cash. Now out of this cash we will be purchasing the raw material. After that we have purchased the raw material. There will be work in progress, like some of the goods, some of the raw material will be worked upon, and some of the raw material will be available as such. Some of the goods will be semi-finished goods, some of the goods will be finished goods over here. So that is all covered over here. After that, when we have produced the actual goods, we'll be having the goods with us which are actually available for sale. Then we will be selling the product over here. Now here comes the selling part over here. Now once we have sold the product, it's not always the case that you'll be receiving the cash. It may also be the case that you are selling it on credit itself. Okay, now let's say if we have actually sold it for cash, we will be receiving the cash again. And further, if we have not received the cash, there will be some other period which will be added to it. Let's say we just give 10 days credit to our buyers over there. So in that particular case, we'll be receiving after cash after 10 days. So actually this is a working capital cycle over here, or the operating cycle over here. Okay, so that is actually quite important to understand, because this particular cycle conveys the idea that what amount of working capital is required by the corporate over here. Okay, let's take the case that the total capital involved in this particular operating cycle over here was 300 lakhs or 300 crores over here, because previously we were using the denomination crores over here. So let's say it is 300 crores over here. Now we learned that the company was having the current assets is equal to 200 crores, and further the company was having the current liabilities is equal to 175 crores. So this is particularly the amount the company's net amount the company is having, that is equal to 25 crore with it. Now actually company does require an extra amount over here that is equal to 275 crores so as to meet up its working capital requirements over here. And according to this particular only, the banks will be financing to this company. Okay, so that's actually related to what? This is actually related to the working capital and operating cycle over here. I hope that you must have understood the important part over here that we have covered so far, that was related to gross working capital, net working capital over there. Then it is related to current assets, the assets which actually do change their form from one form to another during the tenure of 12 months over there. Same way the liabilities which we are to pay in a tenure of 12 months, coming 12 months over here, that's the current liabilities, like account payables, creditors, bills payables, or whatsoever the payables are there, or those are covered under what? Those are covered under the current liabilities over there. Now let's understand the net working capital formula. I have already told you the two formulas. One of it was related to current assets minus the current liabilities. The amount of the current assets that is exceeding over the current liabilities, that is the net working capital. And also if the borrower or the not borrower, let's say the example of the corporate, if the corporate is having surplus of the long-term sources. Now sources, what we are talking about, the liabilities. Okay, so if we are having the surplus of long-term sources over the long-term uses, that is actually also the amount which can be utilized for the working capital purposes over there. So that is also the net working capital. Okay, so that's related to it. Now let's understand the working capital cycle. I have already given you an idea related to that, what it is actually the working capital cycle. Now there are different operations in the business itself. Like first of all, we will be purchasing the raw material, then we will be working upon it, and further the final goods will be produced, and after that we will be selling it, and further we'll be receiving the cash again over there. So the full cycle over here relates to what that is said to be the working capital cycle over here. So here the idea is given again that we were having the cash, we purchased the raw material, production was in progress, there was work in progress, we are having the finished goods, and further we sold it. It may be the case that we must have sold it for the cash, then we will be receiving the cash over here again. But if we have sold it for some credit over there, in that particular case, that period will also be added up. Okay, let's say that the work in progress is for, we purchased the raw material in 5 days and work in progress was for 10 days, and further it took 10 days again so as to sell the goods over here, and the credit period over here was given for 30 days. Okay, now what would be the total operating cycle, working capital cycle period over here? That will be 5 plus 10 plus 10 plus 30, that is equal to 55 days over here. So in this particular case, the working capital cycle would be having a length of 55 days. I hope that you must have understood the idea related to the same, that why we need to understand, because for this particular period over here, our full capital will be utilized, and further we will be out of liquidity. Okay, so that is actually the main purpose, so as to understand the working capital cycle over here. Now we just need to understand the length of the cycle depends upon what? It depends upon the stock of raw material actually that is required to be held, that what stock you require, and for the work in progress, that actually depends upon what? That depends upon what process is to involved over there. Okay, like if it's a lengthy process, if the manufacturing takes a lot of time, then definitely the period will be elongated, otherwise not. And also the credit required by the sellers that we need to actually provide over buyers over there. Okay, so whatsoever the whosoever the purchase over there, we need to basically give a credit period over there. That will be an extra we can say addition to our working capital cycle. Okay, now let's move to the another part. It says the longer is the working capital cycle. The longer is the working capital cycle, more is the working capital requirement. That's quite true, because let's say ki XYZ corporate is having the working capital cycle of 90 days, whereas the ABC corporate is having the working capital cycle of 180 days. What does it indicate? It indicates that the XYZ will be receiving the cash after 90 days and XYZ will be receiving the cash after 180 days. So actually the requirement for working capital is lesser in case of XYZ and more in case of corporate ABC over here. And actually it is very much crucial part so as to assess the cycle over here, because bank's assessment is quite required so as to basically assess the gross working capital, net working capital, and further what the bank finance requirement is over there. That is actually quite important whensoever you are going to finance the working capital to a firm. Okay, now let's move. It's related to importance of the liquidity ratios, that why liquidity ratios are that much important. The liquidity ratios are actually quite important so as to assess the working capital requirements over there, and importantly the current ratio is very important out of the other liquidity ratios. Now what is current ratio? Current ratio is equal to what? It is equal to current assets divided by current liabilities. Now if you are having the current assets over here exceeding the current liabilities, that is the numerator is greater than the denominator, in that particular case this value would be greater than 1, otherwise it would be lesser than 1. And if the current assets are equal to the current liabilities, in that particular case it will be equal to 1. Both these cases are not desirable, because in that particular case the company would not be in the position so as to pay off its recent liabilities over there, and that's not required over there. Okay, so there is a stipulation involved in the assessment of the working capital that the company is to maintain a certain net working capital. Okay, that is to maintain a net working capital. Now what was net working capital? That was equal to current assets minus the current liabilities, or we can say the long term sources minus the long-term uses over here. Okay, so these were the formulas related to it, and this stipulation can be there, that is related to that the company is to maintain a minimum current ratio that is to be maintained at all the times over here. Okay, and when we will be covering the different methods related to the same, and as per the second method of lending, it is 1.33 of the current ratio is to be maintained, minimum of the ratio, and for the as per the method 1 over there, 1.25 current ratio, as per the projected turnover method, that is what? That is the Nayak committee method over there, turnover method over there. The current ratio at 1.25 is to be maintained, and as per the method 1, it is 1.17 of the current ratio which is to be maintained over there. Okay, so we'll be learning about the Tandon committee method 1, method 2, and further the Nayak committee method over there, and further the cash budget management system over there. So this will be the methods that we'll be covering, but the important part over here to understand is that the minimum current ratio is to be maintained, and that can be presented as a stipulation while assessing the working capital requirements over there. Now let's understand the methods of assessment of a bank finance. First of all, it's related to that the bank must be deciding the level of turnover of the enterprise. So turnover is to be decided in case of the existing enterprise. It's quite you can say it's quite easier so as to assess the turnover requirement over there, because they are having a history from which we can assess the turnover over here. And also let's say a firm is XYZ over here, and then in the year 2020 the turnover was 2 crore, in 21 it is 3 crore, in 22 it is 4.5 crore over here. And let's say the projected turnover that for the next year, this is the projected turnover is 10 crore. Now how this is possible? So bank need to assess that whatsoever the projected annual turnover is there, that must be quite in terms of the previous turnovers over there, Okay, but in the case of the new concerns, we must be assessing the projected annual turnover based upon what? Based upon the production capacity of that firm, based upon the proposed market share over there, based upon the availability of the raw materials and the market nature or the industry form over there. So that is the funda, first of all, that we need to assess the actual level of the turnover for the enterprise over there. And the second one, it's related to assessment of the gross or total working capital, that what will be the amount of the total current assets that the company will be having. Now that can be assessed from the inventory or the receivables, that what amount you are going to receive over here, or what receivables you are having right now, or the debtors you are having right now, or the other current assets you are having right now. That is actually related to what? That is related to the total current assets over there. That will be forming the gross working capital over there. Okay, so gross working capital is related to what? That whatsoever the total current assets you are having right now, which can be convertible to the cash within a year and so, okay, or less over there. So those are your, that is actually representing what? That is actually representing the gross working capital over there. Okay, so actually it includes the assets such as the you're having the cash balances, bank balances, account receivables, inventory, stock, etc., short-term investments over there, which are marketable securities, etc. Those are covered under your current assets over there in case of the gross working capital. Okay, that's quite important to understand. Next, it is related to sources for meeting the working capital requirement. Now, from where we can actually meet up with our working capital requirement. First of all, it would be related to the current assets which are exceeding the current liabilities. Current assets which are exceeding the current liabilities, that can be a component related to your net working capital. And the other one, it is related to that whatsoever the long-term sources are having which are exceeding over the long-term uses. So that can also be the component from where the corporate can bring up a capital that must be used as working capital for fixing the working capital requirement over there. Okay, so that is actually related to it. Okay. Now let me tell you the other thing, the other sources which we are having. So these are the sources which will be available from the borrower side. Okay, we are concerning that we are basically considering XYZ is corporate which wants to take a working capital limit from the bank over here. Now it is actually the bank is considering XYZ as borrower over here. So borrower can bring up the capital from what? From where? They can be having the excess of the current assets of the current liabilities, or they must be having the long-term sources exceeding the long-term uses over there. So that is the one source. And the other one it's related to, that is the supplier credit. Now XYZ must be taking raw material from some of the vendors. Okay, let's say PQR is a vendor over here which is supplying the raw material to XYZ, and let's take the case that XYZ is being granted with the credit period of 3 months, that they are to pay for the raw material after a period of 3 months. Now this is the additional credit which is available, which can actually boost the working capital in the firm XYZ over here. Okay, and also other current liabilities such as the salaries payable, advances from customers, etc., which you have there with you. Those are additional current liabilities which are there with you and can be actually utilized, because if you have received the advances from the customers, that is actually a payment which will be shown on the balance sheet in the liability side, but actually you're having the extra funds with you which you can utilize for your working capital purposes. And also the salary payable, you have not paid it yet, those are payable. Okay, so that amount you can actually utilize, that is the amount that you are having right now in your hand and you are handy about it, and further you can utilize this for working capital cycle purposes. Okay, so that's actually related to it. Other than that, it could be the case that the firm may have taken a finance like overdraft or working capital limit, CC limit, etc., from the bank itself. So these are the sources for meeting the working capital requirement over there. I hope that you must have understood all these points related to the sources of working capital requirement over here. Now let's move to the calculation of the bank finance and over here we will be covering three methods majorly. One of it is related to the Tandon committee method. So there were three methods which were suggested by the Tandon committee over there, that these are said to be the MPBF methods. Now what is MPBF? MPBF is maximum permissible bank finance. Okay, so there were three methods which were suggested by the Tandon committee, but the third method was dropped. And for the only two methods were admissible by the Reserve Bank of India. Okay, and the other one, it is the Nayak committee method, that is a projected annual turnover method, and for the third one, it is the cash budget method, which is useful for the seasonal industry over here. So we will be discussing these three methods in detail over here. Okay, now let's jump to these three methods over here. So this is Tandon committee method, that is actually the maximum permissible bank finance over there. So I already told you that there are three methods. So in these all three methods, first of all, we will be actually calculating the working capital gap over there, and then we'll be subtracting the margin. Margin is actually related to what? Margin is actually related to the contribution that is to be maintained, that is the net working capital that is to be maintained by the borrower itself. Okay, either it could be from the long term sources, or it could be related to the new funds which will be infused by the borrower itself. Okay, so in case of first method over there, it is required by the enterprise so as to bring in at least 25% of the working capital gap. Okay, so 25% of the working capital gap is to be maintained over there as margin, and in the second method 25% of the total current assets that is to be maintained as margin, and that is to be subtracted from the working capital gap over there. And in case of the third method over there, the margin that the enterprise must bring in, that is actually related to 100% of the core assets plus 25% of the remaining assets over there. But we are not going to study the third method over here. I just give you an idea related to it. Otherwise you just need to memorize these two methods only, that is the method 1 and the method 2. Now we'll be having a case study, and based upon that we will be understanding that what actually these methods are all about, and further how can we do calculate the current ratio in case of maximum permissible bank finance method 1 and method 2 over there. Okay, so we are having a set of current liabilities and the current assets over here. So we are having the current liabilities such as the creditors for purchases, other current liabilities, and for the TCL other than the bank borrowings, and for the total current liabilities other than the bank borrowings, and further we are having the bank borrowings equal to 200, and on the asset side we are having the raw materials, stock in process, and finished goods, receivables, etc. And we are having the total current liabilities is equal to 350 and the total current assets is equal to 370. Okay, now kindly pay attention to the part that first of all we will be calculating the working capital gap over here. Now what is actually the working capital gap? Working capital gap is equal to what? It is equal to the amount that is the total current assets. Now the total current assets over here are equal to 370 minus the current liabilities, that is equal to 350, and for the current liabilities other than the bank borrowings. Now we are having the bank borrowings equal to 200. Okay, so we'll be subtracting this out of this because 200 has already been there, so as to basically get up with your working capital over there. Okay, so we are going to subtract it, and this particular amount would be what? This would be the working capital gap. This is the actual working capital gap which the firm is actually need to maintain so as to meet up their requirements over there. Because out of this particular amount of 350, 200 amount of the sources have already been borrowed from the bank itself, so we need to subtract that too. Okay, so that is why the working capital gap over here is what? It is 350 minus 200, and further we subtracted this current liabilities other than the bank borrowings from the total current assets over here, and it came out to be what? It came out to be 370 minus 150, that is equal to 220 over there. That is equal to what? That is equal to 220 over there. So whatsoever the amount we were having, this is the net working capital gap. Now in case of the method 1, I told you that the enterprise is to bring in 25% of the working capital gap as margin. Okay, so 25% of the working capital gap is actually the margin that we calculated to be 55. So 25% of 220, that is equal to 55 over here. So that will be the maximum permissible bank finance. So the difference between these two, 220 minus 55, that is the maximum permissible bank finance, that is MPBF, that is allowed under method 1 over here. So what actually we did, we were having the total current assets and we were having the current liabilities. Now out of these current assets, we will be subtracting the current liabilities other than the bank borrowings over here, and that actually how we calculated the working capital gap. Now out of this working capital gap, we are to subtract 25% of the working capital gap as margin, and that will be the amount that is actually be there which can be financed by the bank over there. Okay, so that is actually as per the method 1 over there. Now coming back to the method 2 over here, that is actually I told you what happened over there. The enterprise is to bring in 25% of the margin of the total current assets. Now out of that working capital gap, we calculated to be 220 over here. The margin is to be maintained of 25% of the total current assets. Now the total current assets were 370. So 25% of 370, it is around about 92 over here. We subtracted it out of 220 over here, and it came out to be 128. It came out to be 128. Now you can actually see that the maximum permissible bank finance as per the method 1, we calculated it to be what? We calculated it to be 165 over here, where the enterprise has already borrowed 200 over here. So it is the case of the excessive financing. It is the case of the excessive financing has been done to the enterprise over here. Now what is the previous current ratio? Now, as per the scenario of the current scenario of the enterprise, what was the current ratio? The current ratio is equal to what? The current ratio is equal to current assets divided by the current liabilities. Now the current assets are 370 and further divided by 350 over here. So what is the amount of the current ratio as per the current scenario? So it is 370 divided by 350, that is equal to 1.057. That is quite low. That is quite low over here. That is a current ratio. And if we have financed as per the permissible limits of method 1, what would be the amount of current assets and current liabilities? Now the current assets amount would be the same, that is 370, but as per the method 1 over here. Okay, but what would be the new amount of the current liabilities? It is not 200 as per the method 1, it will be 165 as per the method 1. Now what will be the amount of the new liabilities, current liabilities? That is 100 plus 50. That is 100 plus 50, or we can simply do what? 350 minus 200 plus 165, that is equal to 315 over here. Okay, so what will be the current ratio as per the method 1? So it is 370 divided by 315, that is equal to 1.17. So the current ratio, the minimum current ratio that is maintained in case of MPBF method 1, that is 0.1 is to 1.7, that is 1 is to 1.17 over here. It is 1 is to 1.17 over here. Is that clear? Okay, and further if we look at the method 2, the current assets would be the same, that is 370. What will be the new amount of current liabilities over here? That is 350 minus the borrowings which they had previously, that is 200, and plus the maximum permissible bank finance limit as per the method 2, that is 128. So that will be equal to what? That is equal to 278. Now what will be the new current ratio as per the method 2? It is 370 divided by 278, that is equal to 1.33. So it is 1 is to 1.33. This is the current ratio. This is the current ratio, not this is the current ratio which is maintained in the case of MPBF method 2 over here. So this is the minimum ratio that you need to memorize over here. Is that clear? So you must have understood the method 1, method 2, and how we just calculated the method 1 and method 2. So the questions from this particular point or this particular methods can be asked in the exam. So you must be taking a note of it. So now let's move to the other method, that is the Nayak committee method, that is said to be the annual projected turnover method. Now as per the Nayak committee method, they have actually divided the full year into 4 quarters, and further the turnover is equally divided into 4 parts. So it is the first part, second part, third part, and fourth part, and they have assumed that the limit amount over here, that the turnover here is divided into 4 equal parts over here. Okay, and that particular quarter over here is actually what? It is a one complete working capital cycle. This is a one working capital cycle over here, and this is the second, third, and fourth over here. Okay, is that clear? So actually they have divided into 4 parts over here. So they said that this is actually showcasing what? This is showcasing the one operating cycle, okay, per part over here. Okay, now what will be the total working capital requirement? If we say the total turnover here is 2 crore, what will be the working capital requirement in 1 quarter? Because they have equally divided into 4 quarters over here. For each of the quarter, the total requirement would be 50 lakhs. 50 lakh for quarter 1, for 2, 3rd, and 4th over here. Okay, so 50 lakh is the requirement over here. Now out of this 50 lakh, which is actually what? Which is 25% of the total turnover. Okay, of the total, or we can say projected annual turnover. 25% of the projected annual turnover. If we say this 2 crore rupees is actually what? This is a projected annual turnover. I'm just writing it over here. This is projected annual turnover. Okay, now out of this projected annual turnover, these are actually divided equally into 4 parts. So we can say 25% of the projected annual turnover is the total working capital requirement. That is 50 lakh rupees over here that we have already written over here. Now out of this 50 lakh over here, the margin of 5%, or we can say 5% of the total turnover is to be maintained. Now what is the total turnover? That is 200 lakhs over here, that is 2 crore rupees. So 5% margin of total turnover, 200 lakh into 5%. This is the margin that is to be maintained. This is the margin that is to be maintained. Okay, so this margin is to be maintained. So we can calculate it to be what? We can calculate it to be 10 lakhs over here. We can calculate it to be 10 lakhs over here. Okay, so out of this 50 lakh, 10 lakh would be the margin, and this will be the financed amount. This will be the financed amount. Or simply we can say, what will be the working capital limit? Working capital limit would be the 20% of the projected annual turnover. Or we can simply say it will be 20% of the, what will be the working capital limit? It will be the 20% of the projected annual turnover. Okay, is that clear? We can actually understand in two manners. First of all, it is related to what? That 25% is the total working capital requirement over there. And out of this 25%, 5% is to be maintained as margin, and 20% would be the working capital that will be financed by the bank over there. So we can simply say, in case of NAI committee method or annual projected turnover method, 20% it would be the working capital limit over there. Okay. Now let's move ahead toward the other method, that is a cash budget system. Okay, now in case of enterprises which are having uncertainty in the income, or we can say which are the seasonal industries over there, like software development industry over there or film production over there, now whensoever there will be activity, only then there will be the cash flow over there. Okay, so over there we are to use the cash budget method of assessment over there, and the calculation in this particular case are based on the cash inflows and the cash outflows. Okay, so now cash inflow is the amount that actually you are receiving, and cash outflow is the amount that you are paying over there. Now whatsoever the deficit is over there, like say I'm receiving rupees 3 crore and I'm paying rupees 4 crore over there, so that deficit is 1 crore. I have to pay extra now, so that is the working capital requirement that I need over here. So this is actually we do in case how we do actually assess the working capital requirement in case of cash budget method of assessment. So for this particular purpose, the cash flow statements are prepared on monthly or quarterly basis so as to calculate the need of the working capital requirement for the bank finance over there. Okay, so that's actually related to it. Now we are going to compare all these three methods. One, it was the Tandon committee method. The other one, it was related to the PATO, that is a projected annual turnover method, and the third one, it is related to the cash budget method of assessment over there. So we are going to compare these three methods over there. First of all, it's related to the preciseness with which you will be assessing the working capital requirement. That is actually quite important so as to understand the level of the activity, credit received, and the requirement of the current assets and liabilities over there. And Tandon committee method and NAI committee method are more suitable for those activities which are having a quite certain income, or which we can say where the operations are quite uniform, where the inflows are not volatile that much. Over there we are going to use the Tandon committee method and the NAI committee method over there. But in case we are having the seasonal flow of the cash, we are having not a regular income, or there is volatility, in that particular case we are going to use the cash budget method over there. Okay, so that is actually related to it. And the turnover method is quite useful for those small enterprises where the financial records of that much in-depth detail are not available. Okay. Next, it is related to the bills receivable financed by the banks over there. Now let's understand what are actually the bills receivable. Let's take the case that the A is the seller of the goods and B is the buyer of the goods over here. Now the first transaction could be that A has actually sold the goods and B has paid in cash. The other one, it could be that A has allowed a credit to the B over here. Now if A is actually quite sure about B person over here, in that particular case he can actually allow a credit over there, and the amount so that is pending by the person B to be paid, that will be available as book debt in the books of person A. Okay, that will be assigned as book debt. That is a current asset. That is a current asset. Okay, that is the first part. But now the second part, it is related to that if the person A over here is not quite sure about the standing or the credit worthiness of person B, in that particular case person A can actually draw a bill of exchange. He can actually draw a bill of exchange over here, and bill of exchange is actually what? It is an unconditional order which will be saying that yes, you are to pay this amount to me after this much period, or we are allowing you a credit of this much period over there. And further, when the bill will be actually be accepted by person B will be returning this bill to person A. Now person A is having what? The person A is having an accepted bill by person B in which he has already ordered to pay a sum of amount over there. Okay, and on the due date person A can actually present this bill to person B and can get the payment over there. Otherwise it is having a legal validity and the person A can start with the legal proceedings over there. Now whatsoever the amount is there in which the bills are drawn, by the person A over here, those are actually shown as bills receivables. Those are actually shown as bills receivable in the books of person A over here. Okay, so this amount will be actually the bills receivable. This is also a current asset. Now person A can actually go to his bank and further can ask the bank so as to purchase the bills, so as to discount the bills, and further so as to negotiate the bills over there. Now here we are having the different terminologies related to the different things over here, which we'll be understanding very shortly. Okay, now the bills are actually of two types. One, it is actually related to what? One, it is related to the demand bills, and the other type, it is related to the usage bills over there. Now the demand bills are those bills on which not a particular period of credit is provided, and further whensoever the bill will be presented by the creditor over here, the amount is to be paid by the drawee over here. Okay, now over here A is the drawer of the bill because he has drawn the bill, and further B is the drawee of the bill, or we can simply say B is also the acceptor of bill. Okay, now the payment is to be made whensoever the money is demanded. That is said to be what? That is said to be the demand bill. Okay, but in case a specific period is actually allowed as a credit period to person B, or a specific due date is mentioned on the bill over there, that is said to be what? That is said to be the usage bill of exchange. Okay, that is said to be what? That is said to be the usage bill of exchange over there. Okay, so that is actually related to it. Whensoever a demand bill is given to the bank so as to basically discount the bill over there, that is said to be what? That the bank has purchased the bill. So whensoever it is actually the usage bill, it is a discounted term which is used. And for the bills related to the demand bills, it is a purchased term which is used along the bill financing over there. Okay, and negotiation of the bills is actually related to the bills which are negotiated under the letter of credit over there. So that's a separate part. So over here, this is also mentioned that receivables are part of what? These are part of the current assets of the enterprise, and further this actually arise due to the sales on credit basis to the customers over there. And if the credit sale is there as such and no bill is drawn, in that particular case, it is the account, we can say amount receivables over there. It is said to be the book debts or sundry debtors over there. But in case when the bills have been drawn specifically, it is said to be the bills receivable over there. Okay, so in that particular case, it is the amount which will be indicated under the bills receivable over there. Okay, so another method through which the sales can be there, it is the bill of exchange, where the bill will be drawn by the seller of the goods, and further it will be drawn on person B. So that's why person A is a drawer and person B is the drawee over here, and he is to accept the bills over there. Okay, so let's understand these cases one by one, and you will be having a better understanding. So the first case over here, it is related to if no credit is to be provided to the customer. If no credit is to be provided, in that particular case, a demand bill is drawn. When no credit is to be provided, simply will be drawing a demand bill along with the transfer document. It will be given to the bank. Let's take the case that A has sold the goods. So he will be drawing a demand bill over here, and for the along with the transfer document, A will be giving it to the bank XYZ over here. Now which will has been drawn? It is a demand bill. So in this particular case, the XYZ bank will be purchasing the bill over here. And further can provide up to 100% of the liquidity amount whatsoever mentioned in the demand bill over here. 100% of the amount of the liquidity can be provided to the seller over there, and further will be representing this bill to the buyer of the goods, and buyer is to make the payment to the XYZ bank over here. So that is what is being done in case of if no credit is actually provided to the customer over here. Okay, but the second case is related to if the credit is to be provided on the sales over there. So in that particular case, what will be done? A bill will be drawn. Like A will be drawing a bill, and it will be drawn on person B, and further this bill will be accepted and will be given back to person A over here. Now person A will be going back to the bank over here. Now let's take the case that a credit period of 90 days is allowed for that particular case. The bill cannot be presented to person B for next 90 days, but person A actually over here requires a liquidity. Now the bank over here will be discounting this bill over here. Why it will be discounting? Because the credit period is given. So it is what? It is a usage bill which has been drawn. It is a usage bill which has been drawn, and further the bank will be providing the liquidity after discounting. Let's take the case for a period of 90 days. Whatsoever the interest is there, that will be debited upfront, and further the rest of the amount will be credited to the A's account over here. And further, after 90 days, the bill will be presented to person B, and the amount whatsoever it will be collected over here. So that is the case in case of the bill is actually drawn over there and a credit period is given over there. Okay. Now the advantage of the sales under the bill of exchange is that this is actually governed under the Negotiable Instrument Act, and further there is increased legal protection to the seller of the goods over there in case if there is default by the buyer. Okay, in case there is a default by the buyer, A will be having the better protection, better legal protection over here in that particular case. Okay, so that is the thing related to it. Now let's understand the terms which are used over here. Like I told you that there are three terms. First of all, it is a purchase bill, then it is a discounting the bill, then it is related to negotiating the bill over there. Now purchase is actually used in case of the demand bills, discount is used in case of the usage bills, and negotiation of the is there in case of the bills which are drawn under the letter of credit, and that's a different subject over there. Okay, so we'll be actually coming back to the same very soon, but let's now understand the different concepts related to the bill receivable over there. Okay, now in case of purchase or discount or negotiation of the bill by the bank over there, the outstanding amount, whatsoever the amount is outstanding which is actually not received by the seller over here, is not actually represented in the asset side, because when the bill is already purchased or already discounted by the bank, whatsoever the amount that A was to receive, let's take the case that A made a sale of 1 lakh rupees to person B over here, and the bill was drawn, and further the bill was accepted and given back to person A. The person A went to bank XYZ, and XYZ bank discounted this bill. Let's take the case that 90 days credit period was there and this bill was discounted, and let's take the case that 90,000 rupees were credited to the bank account of person A over here. Now whatsoever the amount was there in the assets of the person A over here, that will not be shown on the asset side in the balance sheet over here, but because previously when the bill was drawn, when it was not discounted, not purchased, not negotiated, it was actually shown as bills receivables in the balance sheet on the current asset side. Okay, but when it has been discounted, it has been purchased, it has been negotiated, in that particular case the outstanding amount of the bill receivable will not be shown on the balance sheet itself, and further it is the case the accounting entry will be adjusted and will not be shown in the asset side, because for that particular bill receivables the amount has already been received by the seller over here, that is a drawer over here from the concerned bank. Okay, so whenever the bill is actually discounted, purchased or negotiated, it is never shown in the asset side of the drawer over there. Okay, so that is the case. Now let's understand the next point, that's related to the guidelines of the Reserve Bank of India related to discounting or rediscounting of the bills by the banks over here. First of all, it is related to, likewise, when we are maintaining, let's say I'm a corporate XYZ and I'm maintaining a stock of rupees 2 crore over here, and bank is allowing me a working capital limit over here. The same way, when XYZ is a corporate and it has been drawing the bills on regular basis and further is having the bill receivables on regular basis, in that particular case the bank can allow the bills limit to the corporate over here after assessing the genuineness and the credit worthiness of the borrower over there, and further it should be a fair trade. It should be fair trade. Whenever the bills are drawn, it should be the fair trade. It should not be related to the accommodation bills or kite flying over there. Kite flying is actually a process. Let's take the case that person A and person B are there who do not have actually a genuine transaction over there, and further they have just drawn a bill. Let's take the case that there is no trade transaction between person A and person B over there, and person A has drawn a bill of rupees 10 lakh on person B and further has allowed a period of 90 days over here. The B has accepted the bill and further has given back to person A. They have a mutual consent that this particular bill will be discounted by A from the bank XYZ. Bank XYZ, based upon the bill, will be discounting the bill and will be providing the finance to the or liquidity to the person A, and further they will be having a division between themselves, and further they will be enjoying the facility over there. But there is no transaction. That is the amount, that is the thing that needs to be remembered over here. So we can say it's actually the accommodation, because it is not a genuine trade practice. Okay, and that is not to be done by the bank itself, and that is actually we can say guideline by the Reserve Bank of India also related to discounting and rediscounting discounting. Okay, so the bill discounting limit can be the bill limit can be sanctioned to a particular customer over there based upon the credit worthiness of the borrower over there, and as per the policy which is approved by the board of directors, and further it should be consistent and confirming the sanctioning of the working capital limits over there. Okay, so that's actually related to the first point over here. Now let's move to the second point, that is actually related to the banks should open letter of credit and further and purchase discount negotiated bill under LC in only in respect of the genuine commercial and trade transaction. Like a letter of credit is actually related to what? Let's say that we are having a exporter in one country and the importer over here is another country, and they're having a agreement between themselves, that is a major contract between themselves, the main contract between themselves, that they will be buying and selling, and what amount will be paid for will be paid, or etc etc. Okay, but they're not sure about the credit worthiness. The exporter is actually worried about what if I will be exporting the goods over there and I will not be receiving the payment, and importer is worried about what if I'll be making the payment and I'll be receiving the no goods or inferior goods over there. So that is a doubt actually which is there in case of exporter and importer over there. So importer over here, which is said to be the applicant, will be going to the bank. Let's say he visited the XYZ bank over here, which is said to be the opening bank, which will be opening the letter of credit over here, and after opening the letter of credit, the letter of credit will be transferred to some other bank, which is said to be the advising bank, which is actually there generally in the country of the exporter over here. That will be advising the letter of credit to the exporter. After going to the letter of credit, that letter of credit is conforming to the main agreement or main contract between the importer and exporter. The exporter will be actually be shipping the goods over here, and after shipping the goods, the exporter will be negotiating the documents, that is the transport documents, we can say bill of lading or CVA bill over here, with the negotiating bank over here, and further the bills will be negotiated, and further after the negotiation the amount will be transferred by the negotiating bank to the exporter over here, and further will be claimed by the negotiating bank from the opening bank over here. So that's the process related to what? That's a process related to the letter of credit over here. If you must have understood, we will be covering it in detail further, but let us just consider the scenario over here. Now, the negotiation, purchase, discounting can only be done in case of genuine commercial and trade transaction who have been the constituent of the regular credit facilities. Okay, so the person, let's take the case exporter, who is having actually the bills with it, and further wants to do what? Wants to actually do what? They want to basically discount the bill. Now that discounting can be allowed to the exporter only and only if they have been sanctioned regular credit facilities. Okay, otherwise not. Okay, so banks should not therefore extend fund-based facilities or non-fund-based facilities to the non-constituent borrowers over there, and any of the non-constituent member of a consortium or multiple banking arrangement over there. So in case the person is non-constituent, in that particular case, the discounting, purchasing, negotiation cannot be done. Okay, so that is the case related to it. Okay, that is related to in case where the negotiation of the bills drawn under the letter of credit. Negotiation of the bills drawn on the letter of credit is actually restricted to one particular bank. I told you the scenario now that we are having the importer, we are having the exporter. Importer went to the bank XYZ, who is the opening bank or issuing bank, which will be actually issuing the letter of credit. It will be transferred to the advising bank over here in the country of the exporter. Advising bank will be actually advising the letter of credit to the exporter. Exporter will be checking the validity of the letter of credit if it is conforming with the main contract, and further will be shipping the goods. And after that, the exporter is now having the shipping documents, with it, and further these documents will be now negotiated with the negotiating bank over here. Okay, negotiating bank over here. Now the exporter will be giving these transport documents to negotiating bank, and negotiating bank will be actually paying the exporter over here. That is the case. But what if this negotiation is actually restricted to one particular bank only? That is the point which is actually said over here. Okay, so it says in case the negotiation of the bills drawn under the letter of credit is actually restricted to one particular bank only, and the beneficiary of the LC is not constituent of that bank. Let's take the case, this was the bank which was actually the specified bank in the letter of credit, that the negotiation of the document is to be done with this bank only, but now the exporter is not actually the constituent of this bank because he or she is not enjoying the working capital facility or the loan facilities from the negotiating bank over here, because I have already told you in that particular case the negotiation, discounting, purchasing cannot be done. It cannot be done. Okay, now the negotiating bank in that particular case can negotiate such LC, but there is a condition related to the same. And what is this condition? it says whatsoever the amount which will be remitted by the negotiating bank to the exporter over here, that is to be remitted, the proceeds are to be remitted only through the bank in which the exporter is a constituent, in which the exporter is a constituent, that is the beneficiary is a constituent over here. Otherwise it cannot be negotiated. Is that clear? Okay, now let's move to the another part. It says if the beneficiary of the LC wants to discount the bills with the LC issuing bank itself. Let's take the case that exporter over here do not want to negotiate the bills or discount the bills, not negotiate. Let's take the case that the exporter has negotiated the bills with the negotiating bank. It has negotiated the export documents with the negotiating bank. Now the exporter is having the bills with it. Exporter is having the bills with it, and exporter wants to discount these bills with the issuing bank over here. It wants to discount the bills with the issuing bank over here. Now what would be the case? In such cases, bank, which is the issuing bank over here, which is the opening bank over here, can actually discount the bills which are drawn by the beneficiary only if the XYZ bank has sanctioned regular fund-based credit facility to the beneficiary over here. Okay, so exporter is the beneficiary, importer is said to be the applicant who applies for the letter of credit, and further on in whose favor the letter of credit is opened, that is the beneficiary over here. Okay, so in case the exporter, the beneficiary, wants to get the bills discounted from the issuing bank itself, that is allowed, but only and only if the regular fund-based facilities, credit facilities are sanctioned to the beneficiary over here. Otherwise it is not allowed. Okay. And so as to ensure that the beneficiary's bank is not deprived of cash flows into its account, the beneficiary should get its bill discounted, negotiated through the bank with whom he is enjoying the sanctioned credit facility over here. Because the case is, whensoever a credit facility is to be allowed to a customer over here, it is to be kept in mind. It may be the case that the customer has taken the credit facility, the working capital facilities from some other bank. Let's take the case that the A bills are going to be discounted. Okay, and it has availed the working capital limit from XYZ bank over here, and further it went to bank PQR over here so as to discount the bills. Now it is mandatory for PQR bank that PQR bank can discount the bills, but the proceeds of these bills must be transferred through the XYZ bank only, not other than that. Okay, because otherwise it will be double game. It will be double crossing. A will be double crossing bank XYZ over here because he has already availed the limit from XYZ bank. Now he's going to discount the bills from the other bank because it's there in their agreement that A will be actually be discounting or further will be purchasing of bill. Everything will be done through the XYZ bank only and not through any other bank. So that's the clause that we need to take care of. Okay. Then it is related to the fourth point over here. The fourth point, it says if the bills are purchased, discounted or negotiated under LC and the payment to the beneficiary has not been made under reserve. Now what do you mean by payment not made under reserve? It means if there is non-compliant presentation by the beneficiary and further the payment will be returned by the beneficiary, and the payment will be repaid by the beneficiary if there is non-compliance related to the same. That is said to be what? That is said to be payment made under reserve. Now, if the payment is not made under reserve, that means if there is any unprincipled criteria or there is any, we can say non-compliance by the beneficiary itself, the payment will not be repaid by the beneficiary to the negotiating bank over there. In that particular case, the exposure will be treated on the LC issuing bank. In that particular case, the exposure will be treated on the LC issuing bank over there and not on the borrower over there. But all other clean negotiations will be confirmed as what? Those will be actually, if there is the payment that is not made under reserve, in that particular case, the risk weight that will be assigned to the over there, that will be assigned as what? That will be assigned as what? The risk weightage will be related to interbank exposure. That will be counted as for what? That will be accounted as for the interbank exposure for the capital adequacy purposes. But if the negotiation is there under reserve, the exposure should be treated on the borrower and not on the bank itself. And the risk weightage will be applicable according to the credit worthiness status of the borrower itself. Okay, so if the payment is not made under reserve, the exposure would be on the issuing bank, and if the payment is made under reserve, in that particular case, the exposure would be on the borrower, and the regular risk weightage will be assigned over there. Okay, and if the clean payment has been made, means if you have paid just as such, okay, in that particular case, the risk weightage assigned would be related to the interbank exposure. Okay, so that's the related to the fourth point. The fifth point, it says, while purchasing, discounting, negotiating bills under the letter of credits, otherwise, banks should establish the genuineness of the transaction. As I told you that in that particular case also, the genuineness of the transaction or the document must be looked into, because in case of letter of credit, the banks are concerned about the documents and not the goods concerned. Okay, so the genuineness of the documents must be there. And further, the practice of drawing bills of exchange claused without recourse and issuing letter of credit bearing the legend without recourse should be discouraged. It should not be there. Now, what do you mean by without recourse? Without recourse means the same thing as per the payment made under reserve. Okay, payment not made under reserve. What does it indicate? It indicate if the bills drawn by the beneficiary, if the bills are drawn by the beneficiary and those are negotiated with the bank over here, and those are documents so negotiated are without recourse. It means what? It means if there is any discrepancy, then the beneficiary would not be basically responsible for the same. So that should be discouraged. So that should be discouraged, because such negotiations actually deprive the negotiating bank of the right of recourse, because they cannot do anything. If there is any discrepancy by the beneficiary itself, the negotiating bank will not be in the position to do anything over there. Okay, so banks should not be opening the letter of credit or purchasing or discounting the bills over there which are having the words or clauses related to the without recourse over there. Is that clear? Okay, banks can actually negotiate the letter of credit, the bills drawn under the letter of credit with recourse or without recourse basis as per their discretion, as per their perception about the credit worthiness of the LC issuing bank over there, because that is actually related to what? That is actually related to the point that you need to take care of yourself. RBI has just issued the guidelines related to it. It is not mandatory related to it. Must be actually be taken care of. That banks must be using the practice that they should not be the clause without recourse. Okay, so that's actually a guideline by the Reserve Bank of India. It is not mandatory. It's upon the discretion of the bank itself, negotiating bank itself, that they must be looking into that what is the credit worthiness and what is the standing of the issuing bank, because the last resort party is the issuing bank itself, which will be actually compensating the amount which will be paid by the negotiating bank to the beneficiary over there. Okay, so that's actually taken care of. And then it is related to accommodation bills should not be purchased, discounted or negotiated by the banks over there. Now I have already told you in brief related to what actually the accommodation bill is all about. And then it is related to bank should be circumspect. Bank should be circumspect while discounting bills drawn by the front finance companies which are set up by the large industrial groups over there. Now let's say we are having a group of companies or a large set of industrial groups over there. Now they are having the front finance companies over there which are actually issuing or drawing the bill of exchange over there. So bank should be quite actually suspicious about it, and further that should be taken care of. Okay, then it's related to bills discounted should be restricted to usage bills held by other banks. Okay, so whatsoever the bill rediscounting is there. Now the word is rediscount. What is actually the word rediscount is? Let's understand this. Now let's take the case that the XYZ seller has actually drawn bills on ABC and has accepted the bill. ABC has accepted the bills. Now the XYZ is having the accepted bills, and XYZ went to the bank PQR so as to get them discounted. Okay, so as to get them discounted, and let's take the case the credit period was for 90 days and the amount involved was rupees 1 lakh. It was rupees 1 lakh. Now PQR has actually discounted the bill and has paid 95,000 to the bank XYZ over here. But now PQR bank is in need of liquidity. The bank is also out of liquidity and they want the liquidity. Now PQR went to some agency. Let's say they went to the Exim Bank over here, which is actually rediscounting the bills. And for the Exim Bank over here, rediscounted the bills and further paid the amount. So they have actually given the bill to they have basically assigned the bill in the name of Exim Bank, and they have actually received the liquidity over here. Now the overall risk is with the PQR, but the PQR is having now what? The PQR is having what? They are having the liquidity with them. First benefit is this. And second one, now the exposure is not related to the borrower. Previously, when they have discounted the bill, the exposure on the bank was related to the borrower over here. But now the exposure is related to what? It is related to interbank interbank borrowings or interbank lending over there. Okay, so the exposure is related to interbank exposure is now there, which is quite lesser over there. So that is also an additional benefit to the PQR over here in case they need to maintain the capital adequacy. Okay, so that's the benefit. So banks rediscounts should be restricted to usage bills held by the other banks. So rediscounting should be related to the usage bills held by the other banks and not related to the retail users. Okay. So banks should not rediscount bills either earlier discounted by the non-banking financial companies. So if it has been discounted by NBFC, so that should not be rediscounted. So it should not be rediscounted except the cases where the bills have been drawn for commercial vehicles or 2 or 3 wheelers. Okay, so that's actually related to the 9th point. So that would be all related to this video. I hope that you must have understood the content and further must have enjoyed the content of the video. So give this video a thumbs up if you have really liked our work, and further the full course videos are available along with the case study videos. Case study videos are also there. Detailed numerical will be there, and further you'll be getting the access to the mock test, and further importantly the chapter wise tests would be there. The chapter wise tests would be there for all the new papers also, and further there will be the mega mock test. There will be the mega mock test and also the complimentary access to the ePDF notes. So that is going to be how you need to be 100% proof related to preparation of CIIB. So do enroll right now. The link is iibf.info, or you can download our Android application, which is available in the name of IIBF Learning Center. And further, if you're iOS user, in that case, download My Institute application. This is for iOS user. Okay, My Institute application over there, and use the organization code GEGKT, and also don't forget to use the coupon that is new 2023, so as to get flat 82% off. And right now we are also having 6 plus 6 months double validity, the Marka offer, where in the cost of 6 months validity you'll be getting 12 months of the validity. Okay, so that would be all. Thank you so much, and see you again in the next video tomorrow.